Hello, and welcome to Mint and Burn, the academic analysis of blockchain and other technologies in the decentralized digital economy. I'm your host, Kelsey Nabin, and we are tuning in remotely from the RMIT University Blockchain Innovation Hub to bring you interesting guests, publications, and experts to test frontier ideas in these emerging industries. This is episode number 5 of Mint and Burn, and today we're talking to Dan Robinson from Paradigm, along with economist Vijay Mohan from RMIT on Ethereum is a Dark Forest and all other interesting recent publications that Dan has been working on with the team. Welcome to both of you.
Thanks for having me on.
Hello. Hello, everyone.
Cool. So just a primer, Dan, it would be great to hear a little bit about your background and how your expertise in coding and law kind of intersects to your interest in blockchains.
Yeah, so I started out my career as a lawyer and a litigator in New York and went to law school and everything, and I didn't really enjoy it. So I decided to leave and do something completely different. I thought was completely different, become an engineer, and then ended up in this weird space where I work primarily in basically mechanism design, and I think I see a lot of parallels between it doing mechanism design for smart contracts and doing some kinds of legal reasoning, but yeah, generally, I find solving technical problems really fascinating, and so that's generally been what's driving me since I joined, and that took me to crypto because I think there's just a lot of interesting unsolved problems here.
Nice. And your role at Paradigm is as a researcher. You're one of the early or first investors in Uniswap. How do you view the AMM space? And can I ask, what's with the forking? Like, why do you think Uniswap has been so successful and there's all these other versions that are pretty much just forks of the code emerging?
Yeah, so I think it's a testament to how successful Uniswap has been that everyone wants to have their own Uniswap and make their own Uniswap. I think we saw that really hit sort of its apex this summer when the most successful Uniswap, sort of AMM other than Uniswap on Ethereum, is just a total direct clone of it, and that was Sushi Swap. I think the partly it's because look, it's open source software. It's a very simple design. Uniswap, compared to a lot of other DeFi protocols, really prizes simplicity, and it doesn't require any kind of governance. It doesn't require a lot of maintenance. And so the simplicity, a lot of things that make it attractive as a decentralized application, also make it often easy to fork. And so I think that's something where, to some extent, Uniswap's almost been too successful in really simplifying its application and really making it easy to use, that's so easy that anyone can do it. That said, I think Uniswap, especially after launching the Uni token, has still been really successful and is still the leader in DEX market share. So which we're happy about.
Yeah, nice. And congratulations to you and the team, obviously V1 and V2 coming out. VJ, you obviously have a slightly different perspective on this space, I guess, with your background as an economist. What are your opinions on kind of the broad DEX AMM space, and kind of should it work as a market?
Yeah, I think for a lot of mainstream economists, this DeFi space is fairly new. Though AMMs have been around for a while, right? I mean, Robin Hanson wrote on AMMs for prediction markets, so we are familiar with this. But just in use of it in finance and just for everyday things like exchanges, that is sort of new. And there's a bit of a learning curve for a lot of economists there, I think, in terms of getting into the DeFi space. Certainly, it seems that just in terms of the setup, I'm quite optimistic about this. I mean, I'm not sure if it'll replace traditional finance, but certainly there's a space for this to do something different, maybe do some things more efficiently. I think Dan has also brought out stuff on borrowing and lending, on yield and things. So there's definitely space to sort of complement traditional financial institutions that we have. And so, in a way, I'm sort of eager to get to Dan's things on the dark forest, because that sort of seems to be the limiting factor over here in terms of how arbitrage can work. But overall, yeah, I think I'm quite optimistic about how this is going to fit into the sort of institutions we have in traditional finance.
So VJ just mentioned the Stella co-authored Medium article on Ethereum is a Dark Forest, where I think part of the reason people enjoyed it is just because you emphasize the kind of adversarial environment of these new digital markets. Can you explain the basic premise of the article?
So the article was about an experience that I had just had where I was trying to pick up money that had been accidentally left in a smart contract in a way that anybody could grab it. And the paradox here is that because it was so easy to recover this money from the smart contract, if I did it, it would show to the world that this money was there. And then a bot could see that I'd picked it up, that it was possible for them to pick it up doing the same thing. And therefore, and then they could submit a transaction that gets included before mine and grabs the money before I'm able to get it. And so this is a particularly strange and paradoxical form of front running. I think there's a more general form, which is much more common, which is when you see something on chain and you see like a specific way to front run it. So one example is if someone's trading on a name like Uniswap, if you do a sandwich attack by pushing the price up ahead of their trade, then their trade executes, and then you do a trade afterward, you can potentially lock in some profits in a way that's kind of similar to how front running works in traditional financial markets. So that's more well understood generally because it's there's parallels in traditional financial markets. But the generalized front runner that I actually ended up encountering and ended up failing to escape. So someone actually took this money when I tried to pick it up. That's like a novel and relatively strange and fascinating thing, I think.
Vijay, what questions did that scenario raise for you?
Yeah, I think so. Dan, fascinating article, by the way. I really enjoyed reading that. So there seems to be a lot of different levels of interaction here, and I think you might have talked about this before as well. But so if you start to unpack this whole thing of what's happening with these bots, at the very first level of, so let's suppose I take Uniswap as a sort of example. The very first level of the problem is that users of Uniswap have to counter these bots who are sort of sniping their activity. Like you said, there are probably two levels at which this happens. The first is a normal transaction, and we're sort of used to this in normal financial markets anyway, where I put a transaction at a price, and if there's a lot of slippage that I allow for, I could get front run on that, and I end up paying a worse price, and that goes off to the arbitrage front runner. So the front running bot. But the second level is, and this is very crucial for the Uniswap functioning, is that as a user, if I spot an arbitrage opportunity and I put in a transaction on which goes into the mempool, I could be sniped against, and that bot could steal my that opportunity that I have found. So I've put resources into finding this opportunity, and then it disappears. So I guess there are a couple of questions around that. The first is, as a user, what can I do to protect myself from that? Is there any way I can counter this bot? And secondly, if I'm constantly being sniped in this way, what's the incentive for me to actually find these arbitrage opportunities?
It's a great question. I think it's really thinking ahead from where we currently are to the logical end state where, yeah, with the expected profit from arbitrage should be zero. I think there's two forms of answer to this. So one is a lot of the arbitrageurs, people who specialize in this, also specialize in winning these what's called priority gas auctions, basically a war to have your transaction included first, or if you fail that, to pay as little as possible in gas for your failed transaction. And that's an art in itself. And if you're very good at that, if you're able to get your transaction propagated and able to respond quickly to other bots that are trying to front run you, then potentially you can win one of those races. And then it's worth it for you, if you're able to consistently win those races, to invest in looking for arbitrages. In the long run, I think the ultimate winners of this, at least on a proof of work blockchain, are likely to be the miners, when, at least as far as the miners are still choosing the order and inclusion of transactions. Because ultimately, and this is why when this phenomenon was first really studied by Phil Dion and some colleagues at Cornell, he called it miner extractable value, because in theory, this money should eventually all go to the miners. Right now, it goes to the miners as gas cost, as just the fees paid by arbitrageurs in gas. Eventually, it'll probably go to the miners just as they can include the arbitrage transaction themselves. And so, someone who is mining can either develop that expertise in house, or they can outsource the ability to capture this kind of miner extractable value. and they are not in the dark forest. They're in a more, in some sense, forgiving environment because they have monopoly on the inclusion of transactions in that particular block.
Yeah, that's really interesting. So in this overall broad picture, the miners are really the king. I don't think. I mean, no one can survive against the miners, right? So if we go to another plane and say we look at this sort of bot to bot interaction, so not only are the bots front running the users, but they're also trying to front run each other. And as you point out, there are these sort of priority gas auctions that they're fighting. And I saw something interesting in that space as well. So every time they bid up the price in an auction, ultimately it's the miners who are benefiting from that. So that there's some sense that you want to cooperate as bots so that at least you can hold off some of these things, gas price, these priority gas auctions, and giving these gas prices to the miners. And I saw a really interesting thing which some of these companies are doing, is some of these bots, I mean, is that they're sort of having this grim strategy that if, we'll bid in a very orderly manner, and if anybody violates our cooperative agreement, then we're just going to blow everything up. But blowing everything up is also, by increasing the bid, the gas bid, to such a high level that all the other bots lose out. So as a miner, I suppose you could just deploy a bot which blows up that auction, and immediately causes this grim strategy to occur. So even that, I mean, once the miners get into this game, it's really game over for everybody else, isn't it?
Will that change with proof of stake? And is that a kind of a transition, an upgraded version for you guys?
I think it's pretty speculative to think about how it will work in ETH2. Like, we're not even sure how smart contracts will work in V2, or how transactions will be constructed or blocks will be constructed once ETH2 has execution, if ever. In existing proof of stake blockchains, as far as I know, everyone involves a single party constructing the block. So maybe that's a proposer in like Tendermint. You do a round robin across all validators, and each one submits one. Sometimes it's one randomly selected in other protocols. But generally, I think if you have one party that can do that, then there's still miner extractable value. Proof of stake doesn't change that. So really, I think you need to do something that kind of changes the miners, prevents any single party from ever having control over over transaction ordering and transaction inclusion. And I think that's an open area of research.
Yeah, some really interesting things in there. I think zooming out on that idea of security, the article also points out kind of increasing datification through mempool analysis, obviously the bot automation, as well as the codependence on other infrastructure like Infuras, kind of like middle layers. What other crucial vulnerabilities do you see, or are you thinking about in terms of how to create long-term sustainable digital infrastructure?
So the obfuscation strategy we used, which ultimately didn't work, although we didn't necessarily execute on it perfectly, involved splitting the transaction into two transactions, one of which would make the other possible, so that if somebody looked at those two transactions in isolation, they wouldn't be able to tell what the second one was ultimately going to do when it was included on the blockchain. That one failed in this case, and I think it's doomed to fail because anything that a miner can do, and ultimately for your transaction to have an effect, it has to be constructed by a miner into a block. Anything they can do, the front runner can do, and so that arms race where we try to just make our transaction as confusing as possible isn't ultimately going to win, because they could just trace the transaction and see in the middle of the transaction what happened and extract how they can make a profit from it. So in these particular situations, it's just not possible to escape someone by making your transaction more complicated. I think for the solutions often, like I said, involve miners. And so after I did this thing, Sam, my now colleague Sam Sun, who's a smart contract security researcher, pulled off a successful rescue of a $10 million hack. Mine was only $10,000 that I lost. He managed to successfully rescue $10 million with the help of a mining pool. And so ultimately, I think like the mining pool gives it just an unfair advantage where they can include the transaction without showing it to anyone. And that's maybe the only way I think to survive in the dark forest.
Can you explain a little bit more about the sealed bid batch auction, and as well as any other kind of mechanisms or even teams that are researching kind of interesting mechanisms on this track of privacy for the sake of kind of usability?
I think that's right, and there's a lot of other benefits, of course, that privacy of blockchain data gets you. It's harder for people right now are revealing basically their entire trading history and transaction history publicly. It's not ideal for a lot of reasons. I think there are, though, like you said, advantages to DeFi being public, and there's even advantages to data in the mempool potentially being public, in that you can respond quickly to something, like arbitrages, even non-malicious arbitrages, where it's like, if I have a trade just trading after me in order to take advantage, I push the price somewhere. That's not really a malicious arbitrage. That you're sort of just keeping the price correct. You're not front running me. You're not hurting me. You're just sort of responding to what my transaction did, the effect that it had. There's some reasons that this can be very efficient, and so I think figuring out how can we get the benefits of transparency on this, both like the whatever public good benefits of it, but also the efficiency benefits of this public data without everything being visible. I think that's very important. I think, for example, like a sealed bid batch auction would be, in theory, a much better way maybe to do on chain exchange, but actually implementing that is quite hard. And there's something even worse, which is that, yes, on the level of an individual block, the miner is king, and ultimately can act as a sovereign and almost make things more fair, or at least more efficient, by basically extracting exactly the right amount of MEV without any wasted amount on competition or anything. There's a higher level game there, though, where the miners are competing against each other for blocks, and that requires, in a proof of work system, it requires an ongoing expenditure from miners. And so one worry here is that once miners start extracting this value, while it could look more orderly on a per block basis, and people aren't going to be able to do all these other arbs, inevitably, if any miner starts extracting maximal amounts of value from this, and this can include censoring transactions and manipulating things arbitrarily and front running users and making the blockchain generally unusable, once they start doing it and they're extracting some higher amount of profit than other miners are from who are just charging normal transaction fees, they're inevitably going to outcompete the miners that don't do this. And so there's a race to the bottom in the game between miners, where eventually one would think like the most evil miners would win. However you can extract as much value as possible from the blockchain, you'll inevitably have cheaper. You'll be able to recoup more in mining costs, and therefore your share of hash power will grow. I don't think this is necessarily actually going to happen, in part because miners, at least what we've seen so far, tend to act in kind of a rationally altruistic way, where they care about the long-term value of the blockchain that they're mining. And that's going to be especially true with proof of stake. But I think it's a dangerous game to start playing, and we're seeing miners already starting to play it.
So, one of the things you described in that article, Dan, is that you sort of used a obfuscation strategy as well. And that seems to be a sort of one way to counter it, at least in the short term, still we, sort of develop better technologies or better systems. That's sort of reminds me of these sort of pursuit and evasion games that you have in game theory, a cat and mouse game where you're sort of trying to develop a strategy to escape a pursuer just long enough for you to survive and get your transaction included in the block. So, how complicated is something like that to implement? I mean, how long can you survive, in a game with a bot? How much time do you need in order for it to be included? What sort of expectation did you have when you devised that obfuscation strategy?
So the obfuscation strategy we used, which ultimately didn't work, although we didn't necessarily execute on it perfectly, involved splitting the transaction into two transactions, one of which would make the other possible, so that if somebody looked at those two transactions in isolation, they wouldn't be able to tell what the second one was ultimately going to do when it was included on the blockchain. That one failed in this case, and I think it's doomed to fail, because anything that a miner can do, and ultimately for your transaction to have an effect, it has to be constructed by a miner into a block. Anything they can do, the front runner can do. And so that arms race, where we try to just make our transaction as confusing as possible, isn't ultimately going to win, because they could just trace the transaction and see in the middle of the transaction what happened and extract how they can make a profit from it. So in these particular situations, it's just not possible to escape someone by making your transaction more complicated.
VJ, I was glad that you mentioned Econ 101 before you jumped in there for the social scientists on the podcast. To take a step back, especially in consideration of listeners, Dan, you wrote a recent piece on Uniswap's financial alchemy and labeled this term volatility harvesting. To make it really simple, what happens when you leave your money in Uniswap liquidities pool?
Yeah. So one way to look at Uniswap, in addition to being an automated market maker, is that it's an automatic portfolio rebalancer. So if you hold your money in Uniswap, it's going to ensure that at all times 50% of it in terms of value is held in one asset and 50% in the other. So as one asset goes up in value, you're gonna sell it, and as it goes down in value, you're gonna buy some more. And because Uniswap charges a fee on trades, that effectively means there's a spread where if the price goes up, you sell it a bit higher of a rate, and then it goes back down. If the price goes up, you're going to sell at a slightly better price for you, and if the price goes back down, you're going to sell at a slightly better price for you, and you end up booking some profit if the price ultimately returns to the same place. You have more money than you started with, and there's actually been a lot of study of what's called the rebalancing portfolio, of something where you have a 50-50 portfolio. And it's actually been found that by a lot of metrics, this portfolio actually often can do better than just holding either of the assets themselves. So diversifying between, if you're holding ETH and USD, as ETH goes up, selling some of the ETH on the way up and then buying ETH as it goes back down, in order to maintain this 50-50 allocation, can actually be cause your wealth to compound more quickly than holding either asset. So I think that's a very interesting result. We weren't sure whether it applied to Uniswap, because the theory, the conditions for that to be true, for the rebalancing portfolio to be profitable, included that you could basically execute a trade. If whenever the price moves, you're able to execute a trade at the new price profitably. So every trade for you at current prices is not unprofitable. Uniswap, because of the way that it works, it's completely passive. It only trades when someone wants to trade with it, which means, if we're assuming that all trades are arbitrage trades, it means that you're always losing money on every trade. And what we weren't sure about was, does this change the property of the rebalancing portfolio? And I think there's theoretical reasons why it might not. And what we found out from we put this out as a problem. My colleague Charlie Noyes published this question that we had about this, and Dave White and Martin Tassi got in touch about it, and with a solution, which is that it turns out, actually, under these idealized conditions, as long as the Uniswap fee, the Uniswap fee, the smaller the Uniswap fee is, the closer it actually is to this rebalancing portfolio, and the more profitable in expectation the pair will be. So that was a very encouraging result, that you can actually approximate this profitable rebalancing strategy, including being able to actually profit from it, with a totally passive strategy that only trades when someone is trading with it.
I had a question about, as these, I guess, new forms of markets unfold, how do you see that intersecting with, existing institutions, especially legal ones? Is that something that you help kind of guide your projects in?
The automation of this and sort of the democratization of things like mempool tools are probably a good thing in the long run. It is playing this role of accelerating the MEV apocalypse, which in some ways could be good or bad. But if you're doing it in an open source way, at least it's possible for researchers to try to look at how this can be countered, to look at how it can be constructed in an ethical way. And so one company actually that we just invested in, called Flashbots, is looking at how to make this kind of MEV extraction software for miners, in a way that's ethical, that doesn't extract too much value from the blockchain, just thus killing the golden goose of Ethereum for these miners, and prevent some of the waste that happens with front running. But I think that's I think it's very difficult to figure out how can we compete in this game, and ultimately, I do think we're going to have to try to solve that problem of, can we be out? Will this ethical MEV extraction tool be outcompeted by unethical ones? And I think trying to figure that out and whether there are strategies to do it, maybe like a grim trigger on a block by block level instead of within a single block. There may be ways to do that.
Yeah, I mean that's exactly what I would expect. That once this, so just to sort of break that argument down, so we've got users versus bots, and probably the bots will win that. We've got bots versus bots, which is sort of a competitive game amongst themselves. We've got bots versus miners. Miners will win that, and then finally the last stage of this sort of game theoretic thing that we've got going is that there are also miner versus miner. And what you described there is exactly what I would expect, which is that the miner who is able to extract as much MEV as possible through whatever method possible is the last miner standing. They'd be able to outcompete everybody else. This sort of thing cannot occur in something like Bitcoin, isn't it? Because there, as long as the majority of the miners are honest, you would still be able to ward off a lot of these, 51% attacks and all that. But here, all you really need is one miner to be dishonest, and they start getting some sort of advantage because they're extracting MEV. And even if 51% of your miners are honest, there's still no way to stop the malicious extraction of MEV by one miner. Is my understanding of that correct?
Yeah. So in traditional finance, right, like other traders can't see when you're trying to hit an order, they can't really see that you're trying to do that until you've actually done it. Now, I think there's a lot of problems with how traditional financial exchanges work at this micro level. Where like I think it's wrong that we have this huge amount of effort going into nanosecond level trading, and in fact, like this is why there's been a lot proposed in terms of doing batch auctions, very short batch auctions, like 1 second or 100 milliseconds, and executing all trades within that are received within that period, as if uh, as if they happen at the same time and netting them against each other. I think there's a lot of potential benefit there. It hasn't really caught on in traditional finance yet, but I think it's kind of that's one of the benefits of DeFi is that we have to experiment with different things. So I'd like to see if anybody out there is working on a batch auction system for crypto for decentralized exchange. I'd be very curious to see it. I think, and the sealed bid part of it, just generally, yeah, makes it harder to game. And I've talked to a few people who are building this. No one's been doing it on Ethereum, in part because it's sort of hard to do. It's hard to do any kind of privacy, especially at this particular level on Ethereum. But I've seen some people trying to do it on other platforms, and I'm curious to see how that develops.
Sorry, so in this minor, so when we look at something like Bitcoin, right? So there, if 51% of the miners are honest, then you would expect that they can block a malicious miner, who's trying to launch a 51% attack or something like that. But in this sort of system, if you've just got one miner who's extracting MEV, over time, there's nothing the honest miners can really do to stop that extraction process, because every time this malicious miner wins a block, they'll be extracting all the MEV, and over time you'd expect that this malicious miner becomes the biggest one and gobbles up all the rest, because there's nothing anyone can really do to stop that. Or do you see that these honest miners sort of form a coalition and they're able to block some malicious miner from extracting MEV?
That's right. So I do think there is a difference between the kind of MEV and the quantity of MEV that's extractable Bitcoin versus on Ethereum. There still is some MEV in Bitcoin. I think the clearest example is Lightning Network transactions, where in theory a miner who can prevent a transaction from being included for a long enough period of time can potentially extract value. I think that's way harder and requires them to collaborate with a Lightning Network participant and to censor blocks for much longer than is generally reasonable. But there's a little MEV there, and then there's also there's a fascinating paper called "On the Instability of Bitcoin in the Absence of the Block Reward" or something like that, and that talks about these games that miners can play in order to reorg recent blocks when those blocks have a lot of fees in them. So there's some games that can happen there, but certainly the games it's not on the same scale as Ethereum. I think you're right that generally it's hard to prevent. it would be possible for a coalition of honest miners on Ethereum to collectively just agree to orphan blocks from some other miner, which would prevent them from eventually accruing enough money to grow to control the entire blockchain or accrue 50%, 51% of hash power themselves. I think that depends on being able to detect this, which may not be possible in an automatic way. You can't necessarily tell whether someone's doing this kind of malicious miner MEV extraction. It maybe could be done by all the miners colluding, but that also is dangerous. Like anything where the miners are starting to collude in order to prevent some other person from participating in the blockchain is kind of a slippery slope toward all kinds of other MEV, all kinds of like censorship and other harmful things to the blockchain. So I think it's a really difficult thing to try to solve, and one that hopefully, we've been looking at things that can try to solve it on the protocol layer.
So, wouldn't maybe one of the so all of this problem starts from the fact that everything is visible to everybody, right? So if the miners can see everything and the bots can see everything, everything can be front run. So probably the cleanest solution to this problem is to start, hiding encrypting transactions, if you like, because then the miners can't really see what's happening. The bots can't understand what the transactions are. Has that ever been? I mean, how do you think likely that is? I mean, that's another sort of, in a way, it's not desirable because the whole thing about the decentralization is also the transparency, and if you go down that path, you could have all kinds of crazy transactions that are encrypted, and I'm not sure even what the regulatory aspect of it. But in a way, that is the cleanest solution, isn't it? That you sort of encrypt things at the transaction level so that no one except the sender really knows what's being sent.
Yes, that's. I think that you described it exactly right. Although with the caveat that the spread in Uniswap really is the fee. So like in Uniswap, there's a 30 bip fee that translates to essentially a 60 bip spread, but that's sort of how you make the profits. And that it takes the form that basically there's this 60 bip window of true price where there is no arbitrage. But yes, as you make that window smaller, you end up capturing more arbitrage volume, which is ultimately good for you. But you're right that if prices diverge, and this could be the case if it's not actually geometric Brownian motion with no drift in log space, where like for example, if one of the assets is Amazon or something, right, then it's just growing over time. If it's Bitcoin, this is growing over the past 10 years. You probably the growth is so much higher than volatility for at least some assets that it's not possible to make a profit from at least a 50-50 portfolio in this. Actually, if growth is a lot higher than if growth is higher, if growth in log space is actually higher than zero, there's a different ideal portfolio for it other than the 50-50 one. But we're still hashing out the details of that. So that's for further study. But yes, I think in general, if the price just diverges and then stays divergent, yeah, like potentially you've made a loss. In the long run, though, we expect that if this price is moving around randomly, it's going to revisit the same point infinitely many times. And so there's this expectation that basically you will as long as it's not actually like drifting in log space, that ultimately you're going to be collecting a lot of money, and like the price change just doesn't matter on an infinite time scale. It's ultimately going to sort of end up predicted the same price.
So overall, Dan, I mean, so are you optimistic in this space that this extractable value and the activity of miners? Are you positive about the space, or are you looking that this is going to be a long process where over the next few years you're going to be battling this problem, and that it could have some sort of more negative conclusion? Because in a way, it is sort of depressing to see all this happening, and it's not just a dark forest, but it's also sort of like, well, we've got so many problems ahead of us to solve. So are you optimistic about the near future, and what kind of timeline are you putting on solutions to these sort of things being found?
It doesn't make an assumption about the number of participants. It does make the assumption that, no arbitrage, is that it's never the case that there is a profit to be made from from arbitraging between Uniswap and Coinbase or wherever the true price of this asset is, and that it isn't picked up. So it makes the no arbitrage assumption, and it makes the assumption that trades can happen instantaneously. And so the combination of those assumptions, which is fairly unrealistic, basically says that, look, the price is moving around in geometric Brownian motion like every nanosecond, and you're collecting if you have a small enough spread, if you have a small enough fee, you're collecting fees like almost every time this happens. And so that's maybe an unrealistic assumption, in general. I think it's an empirical question how accurate that is. Oh, and then there's no transaction costs that people aren't paying gas or anything to trade with it, which is again not a true assumption in this case. But we think it's a useful model. So yeah, so I think it's true though, even if there's only one arbitrager, if there's only one party that's just picking up money from you, and so that's the interesting thing is that it's kind of between you and the arbitrager, you're basically collectively, the arbitrager is profiting from every one of these trades, but what you're profiting from is just the volatility, and the arbitrager is just helping you do it.
Yeah, certainly. I mean, I think there's a lot of exciting research ahead to be done in this area. And in fact, I noticed that you've brought out some recent research on the impermanent loss issue. I saw some Twitter discussion around this. If you could sort of fill us in with what I think you've done at Paradigm with David White and Mark Tassi, and hopefully at the end of it, I can sort of bring it back to some intuitive discussion about what I would expect to see and how that varies from what you've done over there. But if you could just fill us in on this latest development with your research there.
You described it exactly right. Although with the caveat that the spread in Uniswap really is the fee. So like in Uniswap, there's a 30 bip fee that translates to essentially a 60 bip spread, but that's sort of how you make the profits. And that it takes the form that there's this 60 bip window of true price where there is no arbitrage. But yes, as you make that window smaller, you end up capturing more arbitrage volume, which is ultimately good for you. But you're right that if prices diverge, and this could be the case if it's not actually geometric Brownian motion with no drift in log space, where like for example, if one of the assets is Amazon or something, right? Then it's just growing over time. If it's Bitcoin, this is growing over the past 10 years. You probably the growth is so much higher than volatility for at least some assets that it's not possible to make a profit from at least a 50-50 portfolio in this. Actually, if growth is a lot higher than if growth is higher, if growth in log space is actually higher than zero, there's a different ideal portfolio for it other than the 50-50 one. But we're still hashing out the details of that. So that's for further study. But yes, I think in general, if the price just diverges and then stays divergent, yeah, like potentially you've made a loss. In the long run, though, we expect that if this price is moving around randomly, it's going to revisit the same point infinitely many times. And so there's this expectation that basically you will as long as it's not actually like drifting in log space, that ultimately you're going to be collecting a lot of money, and like the price change just doesn't matter on an infinite time scale. It's ultimately going to sort of end up predicted at the same price.
Okay, so that's fairly intuitive, right? So let me see if I can sort of bring this to Econ 101 sort of version, where I just get to the intuition of what's happening here. So if you don't mind, I'll sort of explain this for maybe 3-4 minutes, and then get your feedback on this intuition. So if we start off with the sort of constant product function, we know that the slope of that function, or the negative of that slope of the function, is the price. So if you've got zero fees, you've got the ratio of the two reserves, and that's the price, and everything stops there. If you introduce a fee, what you end up doing is creating a spread. So the lower point of that spread is your bid rate, the upper point is your offer rate, and the higher the fee, the wider that spread becomes. So we can start seeing some trade-offs straight away. And in fact, in this, the liquidity providers not only collect the spread, but they're also collecting the fees, which are like a brokerage fee that they're collecting. So they sort of win twice in this game. Now, if your market price, your reference market price, is sort of between this bid and ask band, if you like, then of course there'll be no arbitrage. But let's suppose it goes a little bit below the bid rate, the reference market price goes a little bit below the bid rate, then immediately you would have arbitrage opportunities opening up, and arbitragers selling into this AMM, and Uniswap would be buying this at the bid rate. I guess where volatility seems to matter here is that if I now jump to the market price jumps to a level above the offer rate, then the arbitrage moves the other way. So you bought from the first arbitrager at a bid price, you'll end up selling to another arbitrager at an offer price. and you make the difference. So this sort of volatility, small volatility, is good where you're moving from one side of the band to the other. And so if I look after two trades, I've say bought token X from one arbitrager at the bid price, sold it to another arbitrager at an offer price, made the difference in the spread, and also got two fees to boot in this. So I mean, that seems to be the intuition of what you're saying there as well. Because if it becomes a volume game at that point, if I make this band really narrow, so I've got these sort of really small fees, then I encourage a lot more arbitrage activity, and I collect, I buy from one arbitrager at a bid rate, sell to another arbitrager at an offer rate, and make the spread and small fees as I go along. And if I've got an infinity of these trades at the theoretical maximum, that's gravy, right? Because I'm making a large volume of these small trades. But if things start moving big, that's where I would expect the liquidity providers to start losing, because you don't have the sort of infinitesimal point, movements on either side of a band. You've got the band disappearing off somewhere, and the liquidity providers, if the band doesn't come back in that case, the liquidity providers are going to bear a huge loss, and that's where you would expect that arbitrageurs start winning in this game, and liquidity providers are going to make losses. Would that intuition be sort of what you have in mind?
Yeah, so there have been a few designs, and I think Bancor V2 was designed this way to try to be able to update the price before arbitrageurs could get there. Bancor V2 actually failed miserably at this, in that exactly what you just said happened, where Oracle updates themselves got front run by traders, and in fact, because of a few other design decisions that Bancor V2 made, it turned out to be a very unprofitable strategy. In fact, I think in general, any strategy where you're trying to actually have informed market making on chain, I think it may be a losing battle. And it's sort of like, when if you're actually trying to cancel orders, for example, in traditional market making faster than they're actually being made, that really depends on you having better infrastructure than the front runners, and it means you can kind of get messed up. You can end up sort of trading and ending up with a weird portfolio. The nice thing about Uniswap is that when you're following this algorithm, no matter who front runs you or who arbits you or however often you get arbed, if prices end up where they started, you have not lost money. It's path invariant. And I think a lot of these other AMMs, and I think Bancor V2 had this problem, are not path invariant, and so they end up bleeding money because someone plays games around with it. So I think it's not impossible that someone comes up with a more informed automated market maker on chain that works better. But I think what we've been learning from studying this is that actually the market maker doesn't need to be informed. The market maker can just be a passive liquidity provider, and this is something that can be done by it's a strategy that scales. It can be done. It's equally efficient to trade with a million traders this way as it is to trade with a single trader, because they all pull their money in Uniswap. And I think we found that I'm very optimistic that something like that, where you don't actually try to beat the arbs, you try to just profit from the arbs, is going to be in the long run the best strategy.
Sorry, and if I could just continue that for one more minute. This also depends on the number of users, doesn't it? Because if you're ultimately relying on collecting spreads from arbitrageurs as this bumps around up and down, if there aren't enough people in this game, you're better off charging a high fee and collecting whatever fees you can from the small volume that exists. So is that one of the assumptions that's gone into this paper, that you've got a large number of players or a large number of trades that's happening over any small period of time? Because if that's not the case, then you're better off charging a high fee and saying, all right, this is sort of like an elasticity argument. If you've got not too much activity going on, then just make the spread as much as possible and collect as much gravy as you can from the few participants. Is that something that's gone into that paper in terms of an assumption?
I'm sort of excited about it. Look, when I got into crypto investing 2 years ago, when I joined Paradigm, it was at the bottom of this brutal bear market. And the big question was, will anyone ever care about what's happening in crypto again? And then before that, I think even when sort of Ethereum was starting, the big question was, is there going to be anything that people care about on this? And so the fact that people are encountering these kind of practical problems, these kind of problems that at least potentially are subject to interesting engineering solutions, I think it's fantastic from just an opportunity perspective. It's fantastic as a venture investor in the space, certainly, to be able to to find someone who's actually found a novel solution to these. It's fantastic as a researcher, and like these are the kind of problems we want to have, not like who cares about blockchain. And I think like as we develop more understanding of these problems, I think we're starting to see more parallels that they have to traditional finance and to other engineering problems also that people have solved. And so it's possible that progress in this area in crypto can benefit from progress in those other areas and potentially can translate to benefits for them. So look, I think the fact that there's a multi-$100 million annual prize for cracking the code of MEV, for figuring out how to maximally extract it without destroying the blockchain. I think I'm optimistic about the ability of researchers and entrepreneurs to find a solution to this.
Yeah, I think that would make sense. You don't need a large number of arbitrageurs, I guess. You just need a large number of trades, really. Even if there's the one arbitrager constantly trading with you. If he's trading or she's trading often enough, then you're still making money from the volatility. Yeah, that would make a lot of intuitive sense. So just to go on with this point, one more thing, which is that you've got this Uniswap, which is entirely reliant on arbitrage to price with the reference market. But you also have things like Bancor and all, which have got this dynamic way of changing the weights. So it's not a 50-50 weight that they have in these. They could have different weights, and they change those weights in order to get the price to match with the reference market. So do you think that sort of system is a bit more stable than Uniswap, especially with reference to the fact that if you've got these bots that are sniping my arbitrage transactions, wouldn't that Bancor system be a bit more reliable in that environment, or can the miners also somehow snipe the Oracle information that these sort of these sort of platforms are relying on?
Yeah, it's been a really informative discussion about some of the threats and the opportunities, specifically in this area. Is there any people or projects that you're specifically interested in looking out for, and what can people look forward to? You mentioned that there's some more research coming out. There's, I guess, updated versions of Uniswap that you're working on, but where can people keep an eye out for you?
Yeah, so I think there's likely to be two paths going forward, and I think Uniswap. Look, Uniswap, the contracts on chain are just they're actually unstoppable. So no matter what happens anywhere, legal or anything, you're gonna see these continue to at least exist unless someone manages to shut down the Ethereum blockchain, right? I think there's still sort of legal questions around how accessible will they be and how accessible will crypto in general be, which I think are big questions. I think we're also going to see adoption of some of these strategies, and this is a way more out there view, as part of traditional financial infrastructure. I think we're going to start to see a collision between market making and emerging of what's traditionally considered market making, which is done right now by these big firms like Citadel and Jump with massive profit margins, and what's currently considered passive investing, which is like investing in an index fund like the S&P 500 through Vanguard or Fidelity or something. And I think I find there to be like some really interesting parallels between passive investing and active investing. This is something I've been working on a blog post about, so I'm not going to spoil too much about what I think about that. But I think it's possible that in the long run, like passive investors who want to hold a 50-50 portfolio and want to rebalance very frequently could actually do so very efficiently by providing liquidity in markets in a way that just hasn't been done before. And I think this is one of the ways in which DeFi, I think, can sort of teach some new ideas to traditional finance, where like this is just something that just hadn't happened, but there wasn't really a reason it hadn't happened in traditional finance. It's not like technically impossible, but the amount of innovation that can happen in DeFi and the strange constraints that DeFi is under, like Uniswap had to be designed in this simple way because it would be impossible to build it as an informed market maker, and it's not efficient to do it as an order book or something on chain. And so it was by necessity that they designed it this way. But actually, we've discovered that there's a lot of merit to that particular construction. So I'm kind of optimistic about both Uniswap continuing to exist as an on-chain decentralized market maker, but also other sort of like entities taking lessons from that, and maybe changing just how markets work.
Yeah, that's really interesting because there are so many possibilities that's open over here. Everything is designed from scratch, and I mean it's an economist's dream to sort of build these institutions from scratch and see how they're being built. So even if I look at just this AMM space, you've got Uniswap, which has a 50-50 balancing. Then you've got Balancer, which has got arbitrary weights, and but if you take Balancer and you allow those weights to be dynamically adjusted, then it translates to Bancor. And you take a couple of different things, you mix them together, and you end up with Curve Finance. It's just fascinating to see how much innovation is going on in this space. And I noticed that even with Uniswap, you've already gone from Uniswap version 1 to 2. Is there a version 3 that's coming up as well?
So yeah, so I can't discuss any future versions of Uniswap. I think there are still, in my view, at least a lot of potential improvements that can be made in the automated market making space, and have worked on them on some of those ideas with Uniswap. Have also worked with some of our other portfolio companies like Yield on designing AMMs that are optimized for different kinds of assets. So with Yield, there's an AMM that's optimized for effectively bonds, these what's called FI tokens, fixed yield tokens, that are redeemable for a fixed amount of money at the end of some period, a fixed amount of DAI. So FI DAI is the token. And the interesting thing is this market maker is sort of an interest rate aware market maker, where it adjusts weights over time based on the anticipated interest rate, as implied by the current price of FI DAI that it is offering it at. So it's a cool formula. It's called Yield Space, this AMM. And I think this shows that I actually am quite optimistic about Uniswap, and I think and Balancers as sort of a variant on it for the case of assets that act like geometric Brownian motion. But I think for other assets, for things like bonds, for things like options, prediction market shares, where you know something about it, where there's might be an expiration date, or you might know something about sort of changes in its volatility over time, where you could have a market maker that's more aware of that, and is still passive, still doesn't require anyone to be feeding Oracle updates to it or anything, but can gradually adjust both the shape of the curve and over time potentially the price based on some model of how it expects these prices to move. So for totally uncorrelated, just random moving assets, I think Uniswap is close to optimal. But I think for weirder assets, for ones with special relationships to each other, I think there's you see with Curve offering between stable coins. There are other ways to do it, and ones that aren't